So what's really interesting is you're focusing on the reopening of China's factories, and you say that in either case, even if they reopen or they don't, that's negative for equities. Why?
The risk here is that as factories reopen, there is more movement of people, more people come in contact with each other, and as a result, we see a reacceleration of virus spreading. And that could force factory closures down the road, more factory closures down the road. Or it could be the case that the Chinese authorities are not comfortable yet to allow a wide opening of factories, so we could have effectively delaying these factory reopenings, and they might not open as widely as the market expects. 1 week of closure costs a lot to Chinese GDP, around 4 to 5% in terms of annualized GDP growth for Q1. So whether, factories widely open on Monday or whether this is delayed by 1 week makes a huge difference.
Absolutely, and that could then, if the factory openings are delayed, that could sort of spoil your base case of a V-shaped recovery in China. You're still overweight equities though, right?
Yes,
you've just trimmed the overweight and it's tactical. How much, and you've got more reasons than just the openings as well. Part of it's to do with positioning, right?
Indeed. We should not forget that the market is, in particular the US equity market, is close to record highs, and that the position backdrop at the beginning of this year is almost the mirror image of what we saw at the beginning of 2019. 2019 was a very strong year for equities because institutional investors had started the year very underweight equities.
Yes.
We have the opposite this year.
On the equities, though, what about volatility? How do you choose to trade that at the moment? Do you see a pickup? And if so, where are the best opportunities?
At the minimum, what China coronavirus issue is going to do is to cloud the macro picture. There is for sure going to have a big decline in global manufacturing PMIs over the coming month or two, and we're going to see a lot of uncertainty. And the markets will not be sure how much of that decline in global PMIs is going to be virus-related, how much is not going to be virus-related. So I think the macro backdrop right now is more conducive to long volatility positions. And I think volatility risk premium embedded in option markets right now are rather low, and in particular in segments like the Eurostoxx 50 or the MSCI IM index, where implied to realized vol ratios are as low as 0.7, 0.8. So that makes it attractive to be long vol in these places.